This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 22, 2026, and this is the New York pre-market. Now, let's get into it. Bitcoin is sitting at $65,604, down 1.4%, but the silence in the order book is louder than the price drop. With futures demand hitting 2024 lows and the fear and greed index pinned at 14 out of 100, we are looking at a market stripped of leverage and drowning in extreme fear. There are no specific economic data releases or central bank decisions on the immediate calendar for this session. However, the structural events are unfolding right now. We are watching the aftermath of the U.S. Senate housing bill passing with a CBDC ban and the ongoing legal maneuvers regarding the $327,000 ETHUSD recovery from romance fraud. Additionally, the market is digesting the implications of PayPay's $1.1 billion NASDAQ IPO pursuit and Core Scientific's disappointing fourth-quarter results. These are the structural tectonic plates shifting beneath the spot price.
What to watch for is how the Core Scientific disappointment intersects with the broader liquidity squeeze. If infrastructure operators like Core Scientific are struggling with fundamentals, while futures demand evaporates, that double negative pressure on Bitcoin's floor needs monitoring before any new liquidity enters the system.
Here is the snapshot. The total market cap is $2.32 trillion, down 1.27%. Bitcoin leads the bleed at $65,604, minus 1.4%. Ethereum is at $1,918.91, off 1.09%. Solana is 77.22, down 1.64%. XRP is holding relatively steady at $1.14, minus 0.63%. And Dogecoin is at 7 cents 24, down 1.49%. The VIX is at 18.65, barely moving, while the crypto fear and greed index screams extreme fear at 14. Three headlines are defining the tone today. First, Cointelegraph reports that Iranian crypto outflows spiked 700% after U.S.-Israeli airstrikes. Second, CoinDesk notes that the U.S. Senate housing bill includes a CBDC ban. Third, Cointelegraph highlights that Bitcoin futures demand has fallen to 2024 lows, raising questions about institutional exit.
Let's look at the risk in that first headline. That 700% spike in Iranian outflows isn't just a regional anomaly. It injects a massive geopolitical risk premium into stablecoin flows. When capital flees traditional banking systems for crypto during geopolitical shocks, you don't get orderly appreciation. You get erratic volume spikes and potential slippage events in Middle Eastern trading pairs. That threatens the integrity of the $68.6 billion daily volume we're seeing.
And that volume is where the second headline bites harder. The Senate CBDC ban sounds like a tailwind for privacy, but in the short term, the market is pricing in regulatory uncertainty, not long-term structural benefit. Meanwhile, Bitfinex is reviving tokenized bonds, and TD Securities is calling NYSE tokenization an institutional turning point. But look at the data. Total market cap is shrinking. Capital isn't rotating into these new tokenized structures yet. It's fleeing the ecosystem entirely. The turning point narrative is clashing with the reality of a contracting balance sheet.
The sentiment reflects that clash. We are at 14 out of 100. That is not just low, it is capitulation. The community buzz is dominated by exit liquidity narratives. People aren't talking about long-term adoption. They're talking about where to hide cash because they don't trust the current venues. The 7-day trend is 12, which is slightly better than today's 14, suggesting the panic might be slowing, but the emotion is still deeply negative. This isn't a dip-buying environment. It's a don't-touch-the-asset environment. Let's dig into Bitcoin. It is at $65,604, down 1.4%. Grid, you own the technicals here. What does the chart say given the collapse in futures demand?
It says we are in a liquidity vacuum. Bitcoin's retreat to 65,604 is technically a break of recent consolidation, but the more important metric is the divergence. Futures demand is at 2024 lows, yet the spot price has only dropped 1.4%. This tells me that leveraged long liquidations, not spot accumulation, are driving this move. The order book is thin. There is no speculative leverage to cushion the fall, which makes the current price action fragile. Bitcoin dominance is holding at 56.66%, meaning capital is staying in Bitcoin rather than rotating to alts, but that's not confidence. It's a flight to quality in a sinking ship.
I need to push back on the idea that this is just fragile. This is a structural withdrawal of institutional hedging. When futures demand hits 2024 lows, you lose the primary buffer for price discovery. Look at Uniswap gaining 2.35%. That is where the liquidity is going, into compliant, fee-generating infrastructure. Bitcoin spot is holding because there are no buyers actively pushing it up, only sellers who have exhausted their inventory. The stability of 65,604 is artificial. It's maintained by the absence of active speculative capital, not by conviction.
And that absence of capital is the danger. Apex argued earlier that tokenization might offset this exit, but SPECTER here is auditing that claim. The data shows total market cap bleeding and Ethereum dominance declining. You cannot rely on a narrative of future tokenization when the present reality is a liquidity void. With the VIX sitting at 18.65, equities are complacent. If equities suddenly wake up to the crypto disconnect, we could see a violent repricing. The current setup favors further erosion until new liquidity enters. Waiting for a bounce in a zero-leverage environment is statistically inferior to waiting for volume confirmation.
So Pulse, we have Grid flagging the thin order book and CIPHER noting the institutional hedge withdrawal. Where does the sentiment sit? Is the 14 out of 100 fear and greed score a contrarian buy signal, or are we still in freefall?
14 out of 100 is historically a contrarian buy signal, but only if the momentum stops. The 7-day trend is 12, which is a slow rise from deeper lows. That suggests panic selling is exhausting itself. We aren't seeing acceleration in the fear. We are seeing consolidation of it. If the score holds above 12 over the next 24 hours, we might see a short squeeze driven by that collapsed futures demand. But if it drops below 10, expect renewed capitulation. Moving to Ethereum. It is at 1,918.91, down 1.09%. CIPHER, how is the flow data looking here compared to Bitcoin?
Ethereum is showing weaker correlation strength. Its dominance has declined to 9.97%. While Bitcoin is holding steady as a relative safe haven, Ethereum is getting left behind. The decentralized finance TVL rotation I mentioned, moving into Uniswap and compliant infrastructure, is happening primarily on Ethereum, but the price hasn't caught up. The liquidity is there, but the speculative wrapper has popped. Tron is gaining 0.4%, keeping stablecoin utility alive, but Ethereum's native token is struggling to find a bid in the absence of futures leverage.
Technically, Ethereum is breaking down relative to Bitcoin. If Ethereum cannot hold above 1900, the breakdown accelerates. The key here is that Ethereum beta is higher. When Bitcoin dumps 1.4%, Ethereum dumping 1.09% looks okay in isolation, but in a low liquidity environment, that stability is likely to snap. There is no support level that matters if the funding rates remain negative. The structure is compromised.
I agree with Grid. The decline in Ethereum dominance to 9.97% is a warning sign. It means capital is not rotating into Ethereum as a better tech bet. It is rotating out of the entire smart contract platform sector into cash or Bitcoin. The core scientific disappointment also weighs here. If miners and infrastructure providers are seeing margin compression, the ecosystem supporting Ethereum and Bitcoin both feels the pressure. The yield narrative isn't saving the price.
On the sentiment side, the community chatter around Ethereum is less panicked than Bitcoin, but more confused. Traders are wondering if the split in performance between Bitcoin and Ethereum marks a permanent regime change. At 14 out of 100 overall fear, there isn't much energy to debate fundamental differences. Everyone is just trying to preserve capital. The lack of enthusiasm for Ethereum right now is telling. Solana is at 77.22, down 1.64%. A higher beta test. Grid, what's the picture here?
77.22 is testing lower supports. With Bitcoin holding at 65,000, Solana is underperforming, dropping nearly double the percentage of Bitcoin. This confirms that high beta assets are getting sold first. The 24-hour high was 78.51 and we've lost that ground. In a risk-off environment, Solana's narrative of speed and low cost doesn't matter if traders are deleveraging. The volume contraction I saw earlier applies doubly here. There isn't enough depth to sustain a rally.
Flow-wise, Solana is suffering from the same liquidity vacuum. The funds that used to trade Solana on leverage are gone. What's left is spot traders reacting to Bitcoin's moves. Since Bitcoin is weak, Solana is weak. The only interesting dynamic is that unlike XRP, which is holding up at $1.14, Solana has no defensive moat. It's pure risk-on exposure. With the VIX at 18.65, risk-on assets are getting crushed.
The risk flag here is simple. Solana is a proxy for liquidity conditions. If liquidity doesn't return, Solana doesn't just consolidate, it grinds lower. The $876 million total market cap contraction affects high beta chains hardest. Unless we see a surge in open interest, this is a dead cat bounce waiting to happen.
Let's look at the outliers. XRP is at $1.14, down only 0.63%. Uniswap is up 2.35%. Tron TRX is up 0.43%. Why are these moving differently?
XRP is showing defensive positioning. It's often correlated with regulatory clarity rather than pure tech specs. With the Senate CBDC ban making headlines, XRP holders might be interpreting that as a win for non-CBDC assets, providing a floor. Technically, $1.14 is a key psychological level, and the lower volatility gives it relative strength.
I see it as a flow story. Tron is up 40 basis points because it is the hub for stablecoin issuance and transfers. Even when price is down, the utility remains. Money needs to move. TRX captures that fee revenue. Uniswap is up 2.35% because it is a compliant decentralized finance giant. In an extreme fear environment, capital rotates into assets with clear revenue models and regulatory standing. It's a defense mechanism. Investors want fees, not promises.
Sentimentally, this is a sleeping dog moment. XRP isn't exciting anyone right now, which is why it's holding up. The excitement is all in the downside for Bitcoin and Ethereum. But Uniswap's gain suggests that traders are picking winners based on safety. They aren't buying the whole basket. They are cherry-picking the safest yields available. It's a fragmented market.
Be careful with the XRP defense. The 700% spike in Iranian outflows could disrupt XRP if it becomes a conduit for illicit flows again. Regulators are already eyeing stablecoins and cross-border payments. The CBDC ban helps privacy, but it also invites scrutiny on existing players. The upside is limited by regulation. The downside is unlimited by liquidity. I treat XRP's stability as temporary.
Synthesizing this, we have a market where Bitcoin is holding due to lack of sellers, not buyers. Ethereum and Solana are bleeding as liquidity dries up. Alts like Uniswap and XRP are showing pockets of defensive rotation, but the overall structure is broken by the collapse in futures demand. The 14 out of 100 fear and greed score confirms nobody wants to be long right now.
So, where does that leave us? Grid highlighted the liquidity vacuum and thin order books. CIPHER pointed to the structural withdrawal of institutional hedging. SPECTER warned of the geopolitical risk and the danger of complacency in the VIX. And Pulse noted that while fear is extreme, it may be consolidating. Apex tie it together.
The data shows a market in a liquidity-starved equilibrium. Grid observation that technical floors are irrelevant without volume is supported by CIPHER data on futures demand hitting 2024 lows. SPECTER warning about the VIX masking crypto-specific risk is critical. If equities stay calm while crypto unwinds, the eventual synchronization could be painful. Pulse note on the 12 trend line is the only glimmer of hope, suggesting the panic might be peaking. But we need to see funding rates turn positive and volume return before we call a bottom. Currently, we are observing a structural dislocation, not a temporary dip.
To summarize, Bitcoin is at $65,604, held up by thin liquidity rather than strong demand. The Fear and Greed Index is at 14 out of 100, indicating extreme sentiment, but the 7-day trend suggests a potential consolidation phase. Key risks include geopolitical spikes in outflows and the continued collapse of futures demand. Tomorrow, watch for funding rate adjustments and any updates on the Senate CBDC ban implementation. Stay disciplined, monitor the volume, and guard your capital. This is ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.